Joining us is Brian Reynolds, the Chief Market Strategist at Reynolds Strategy. Brian, great to see you. It's been a while, and I don't want to fully put words in your mouth unless I'm saying this correctly, but you're pretty bullish on the market, broadly speaking. So you just think that the earnings season itself is going to disappoint and underwhelm? Explain all of the data points that you're watching.
Bullish on financial engineering, which drives stock prices higher, but the fundamentals are challenging, largely because of tariffs. Corporate taxes were due last week. It happens in the middle at the last month of every quarter. And so the numbers came in and they were down 18%. There hasn't been a drop since the start of the pandemic. Now, that's not a disaster for the S&P 500 because it's probably concentrated in the smaller companies that can't avoid tariffs. Larger companies can lay off people, which the tech companies have done. They can trim their capital spending, which you're seeing some of the companies lowering their guidance to. And they're big enough that they can access the credit market, borrow money to jack their stock price up. And so you've got that dichotomy. The real issue here, to me, is that this is going to cut federal budget inflows. The administration thought tariffs would decrease the deficit. Instead, we just wiped out all the gains from tariffs through corporate profits declines. That means the budget deficit is going to be bigger than thought, and that's going to add to near-term volatility before stocks push on to new highs.
Absolutely. I mean, it's a great point. So a couple of follow-up questions. One would be, are we sure that the early read on this or the quarterly read is, necessarily going to hold for the rest of the year? Could we see a rebound or a turnaround, especially as mentioned, maybe something comes through on the budget front that helps companies with their profits? I mean, Vahan Janjigian earlier this hour was literally saying this very thing, that he doesn't think stock prices should be back to all-time highs because there is this big tariff tax effectively, and now your data is backing that up, right?
Yes, and I think the budget is pretty much set, so that's in the market. What's not in the market is what happens to tariffs, because who knows what this administration is going to do over the next 2 to 3 months to tariffs. They've had a history of throwing out big tariff numbers and then backtracking. So that could be more volatility. But eventually, by the end of summer, that should be behind us. We'll pretty much know whether there's going to be a lot of tariffs or a little bit of tariffs. And if there's tariffs, that's going to mean stocks are more expensive because profits will be down. Retail sales also dropped this month because consumers have finite incomes. They can't offset the inflation that comes from tariffs. That means fundamentally stocks are more expensive, and that forces investors into difficult choices because mechanically these stock buybacks driven by the credit market. XAI, I wrote about last week, was a prime example of a junkie company coming to market and people buying its debt. And that supports stock prices. That should eventually take stock prices to new highs. Institutions are really bearish. They hit a record for short selling as a percent of shares last month. If we get to a new high and go about 100 points higher on the S&P, that means margin clerks on Wall Street are going to force those institutions to cover their shorts. That pushes stock prices up even more. Eventually, later this year, I think that means stocks get overheated. If they get to one standard deviation above trend, which is, let's call it 6,500, 6,600 on the S&P 500, I would want to be a seller into those higher prices.
Do you think, Brian, quickly, that stock buybacks have led to permanently higher stock market valuation? So basically it means that everybody's right. Those who think the market is overvalued, they're right. Those who think the market's going to keep going up, they're right. That this has just become that important of a factor.
It's been since the financial crisis in 2008, it's been the leading cause of higher stock prices. That's ingrained in the market. And if you look at the ratio of earnings yields, which is the flip side of PE ratios for stocks, if you compare that to junk yields, they're about fairly valued. So there's ammunition for both. And what we found is that buybacks lag stock price moves. They slowed down this winter when stocks hit new highs. They accelerated after the panic of April, and now they're taking stocks to new highs. Eventually, they will peter out for a little while. The short covering will run its course, and we'll have a correction, but probably not till later this year.